Hello everyone, this is Xavier Crowley on behalf of the UNSW Economic Society here for the market recap of the week leading up to the 19th of July 2021. This week we have a COVID update, the Australian M&A boom, Australia-China investment and unemployment and other data. To start, an update on the current state of COVID. Sydney's lockdown will be extended by at least 2 weeks to the 30th of July after New South Wales recorded 97 new coronavirus infections on Wednesday and continue to hover around that level. Separately, Victoria has started to record more cases, with 17 cases on Saturday as the outbreak in Sydney seeps into Melbourne. The Victorian city entered a snap 5-day lockdown from Friday last week. On support packages, businesses and economists reacted positively to the New South Wales and federal government's financial support package announced on Tuesday. Businesses with turnover up to $50 million will receive cash payments of up to $10,000, while workers can receive up to $600 per week. While the package is not enough to offset the damage to economic growth, it was seen putting up a floor under income and demand, allowing a quicker recovery when Sydney hopefully opens up again soon. Unsurprisingly, Trade and Tourism Minister Dan Tehan announced that Australia's travel bubble with Singapore has been delayed until at least the end of 2021, after it was meant to launch in just the next couple of weeks. While more than 35% of Singaporean adults are fully vaccinated, over just 10% of Australians were. Moreover, Sydney and Victoria's coronavirus outbreaks has further dented the feasibility and appeal of a travel bubble between the two countries for the time being. On growth, reports highlight estimates that a 7-week lockdown of Sydney could slice 1.4% from third quarter growth of 2021, enough to cause a contraction. Treasury estimates the Sydney lockdown costing $700 million per week, and general consensuses seem to be for no or minimal growth in Q3. The aforementioned $5 billion income and business support package will help cushion the blow, though likely not by enough to offset the expected loss of employment as well. Some estimate the lockdown will see 5 to 10k workers per week join the unemployment queue. For supply chains, there are reports that the decision to slash international arrival caps will cause significant freight delays and potential spikes in the price of imported goods into Australia. Highlighting Australia's vulnerability, cargo consultants warned that freight coming in on the belly of a passenger aircraft is about 80%, whereas globally, it's actually closer to 50%. The piece noted that the government is considering extending its $780 million international freight assistance mechanism to keep the freight lines open and to keep our store shelves stacked. Now, moving on to mergers and acquisitions. The latest data from Refinitiv showed 422 deals worth a record $87.6 billion were announced in the June quarter, more than 3 times the $27.7 billion from the previous quarter in 2020. The M&A rush has been fueled by cheap debt as private equity firms ramp up participation in Australian transactions following a period of underrepresentation. This low cost of debt is underpinned by historically expansive monetary policy and an increasing demand for yield pushing down the cost of capital. We've also seen some very high-profile bids for Australian infrastructure, with Sydney Airport bravely turning down an initial $30 billion bid this week from IFM, QSuper and Global Infrastructure Partners, along with KKR's and Canada's Ontario Teachers Pension Plan bidding $5 billion for Spark Infrastructure, the major owner of Victoria's transmission and electrical lines. Moving on to Australia-China relations, KPMG earlier this week noted that Chinese investment in Australia fell 27% year over year in 2020 to $2.5 billion, the lowest since 2007. The number of deals had fallen from 42 in 2019 to just 20 in 2020, as 75% of investors from China reported they were reluctant to invest because of the political climate. Chinese government restrictions, tighter regulatory scrutiny of Australia and declining confidence in political leadership were cited as contributing factors to the drop in investment. The Foreign Investment Review Board has also taken a harder stance against Chinese investment in key Australian assets, which is really just any asset they don't want Chinese investors to own. Now to the data. June employment has come in red hot, adding 29.1 thousand jobs month on month versus consensus 20,000. The unemployment rate dropping to 4.9% from 5.1% in May, and the participation rate holding constant at 66.2%. Very strong data indeed, but underperforming was the underemployment rate, which increased from 7.4% in May to 7.9% in June, concurrent with monthly hours worked reducing 33 million. We're likely to see a slight uptick in unemployment from the extended Sydney and now Melbourne lockdowns. Elsewhere, June NAB business conditions up 24 versus 37 in May, and business confidence up 11 versus 20 in May. That's all from me. Have a great week.